Welcome to the deep dive. Today we are cracking open the financial reports of one of the largest U.S. protein producers.
A real giant in the industry. It's a company with, incredibly deep roots, founded back in 1935.
And still family-led, right? 4 generations.
That's right. So our mission today is to, solve a bit of a financial mystery. On one hand, this is a global leader, a household name.
And the top-line numbers look good. Consolidated sales grew to, $54.4 billion?
$54.4 billion, a 2.1% increase. That's the kind of number you'd normally celebrate.
But, and this is the big but, that growth hides a financial disaster, really.
It really does, because despite those growing sales, their operating income just plummeted. It fell off a cliff.
Okay, give us the numbers.
In fiscal 2024, they posted $1.409 billion in operating income. A year later, that drops to $1.098 billion.
So over $300 million in profit just gone.
Vanished.
Okay, let's unpack this right away. When your revenue is going up but your profit sinks by more than 20%, something structural is broken. We need to find the monster that ate that profit.
It wasn't just one monster. It was really 2 different storms hitting at the same time.
2 storms?
Yeah. The first was extreme volatility in their commodity businesses. The second was just these extraordinary legal costs. If you look at their 4 main segments, beef, pork, chicken, and prepared foods, you see this huge split, a story of winners and losers.
All right, so which parts of the business were actually making money? Who was pulling the weight?
All the profit, all of it, came from the branded value-added side. Prepared foods had the highest operating margin.
A robust 9.0%. That's the segment with all the household names, isn't it?
Exactly. Jimmy Dean, Hillshire Farm, Ballparky,
right.
The stuff you find in the frozen and refrigerated aisles, ready to eat, ready to cook.
And consumers will pay for that convenience.
They absolutely will. It stabilizes the margins. The chicken segment was also a very strong performer, hitting an 8.5% operating margin.
And the key there is their structure, right? They're vertically integrated.
Completely. And that's so critical.
So vertical integration. You mean they control everything from the very beginning?
Everything. From the breeding stock, they own a subsidiary called Cobb Ventures that handles the genetics all the way through feed production and final processing.
And that control shields them.
It's a massive defense against the kind of volatility we see in the open market. It lets them protect that 8.5% margin.
Okay, so now let's contrast that with the commodity side. I'm guessing beef and pork are where we're going to find our missing profit.
You'd be 100% right. Both of them were operating at a loss.
A loss.
A significant loss. Pork had a negative operating margin of 3.4%. But beef was the real disaster zone, a negative 5.2% operating margin. They were literally paying to run their beef segment this year.
So what happened? What pushed them so deep into the red? It sounds like they got completely blindsided by input costs.
They did. Their total cost of sales jumped by nearly $1.2 billion. And the driver was almost entirely live animal costs.
Okay.
Just in the beef segment alone, the increase in cattle costs was about $1.84 billion.
$1.84 billion?
Yeah.
Just for cattle. That's a historic squeeze on supply.
It is, and it forced a major reckoning. This crisis led to a huge admission in their fiscal 2025 report, a $343 million goodwill impairment charge.
Which completely wiped out the rest of the goodwill for that unit.
Exactly.
Hold on, let's break that down. Goodwill impairment. For you listening, this isn't just some fancy accounting term.
No, it's a huge deal.
It's a public admission that the beef business is not worth what they thought it was. They're saying the future profits they expected to make just aren't going to materialize.
That's the consequence. They stated it was directly due to the tight supply of cattle and high costs. This is the key part. They said the cattle herd rebuilding cycle is going to take much longer than they'd previously hoped.
So monster number 1 was the operational crisis in commodities. Now let's pivot to the second monster, which frankly is even more astonishing.
The legal expenses.
The legal expenses. The single biggest drain on their income outside of operations.
It's a shocking number. The total legal contingency accruals went from $174 million in fiscal 2024 to $738 million in fiscal 2025.
$738 million. Just let that sink in. And that's not money they've necessarily paid out yet, right?
Correct. It's money they have to set aside on the books because they know these bills are coming due. These are historical liabilities from claims of market manipulation and collusion.
It's a huge amount of capital just tied up in dealing with the past.
And that money is concentrated in these massive industry-wide antitrust battles. For the beef antitrust litigation, they accrued $318 million in this fiscal year alone.
And the allegations there are that they conspired to reduce what they paid for cattle.
Yes, and to manipulate futures. So on one hand, they're paying record-high prices for cattle now, and on the other, they're fighting lawsuits from the very producers who sell them that cattle.
What an operational headache.
It's an impossible position. And then you have the pork antitrust litigation. The accrual there was even higher.
How much?
$380 million recorded in fiscal 2025. Now, they have started to settle some pieces of that. $50 million here, $85 million there, but they're still expecting major trials to kick off next year. This is not over.
And what's the status of the broiler, the chicken litigation? That's been going on for a while.
It has. They settled with the main classes, but they're still negotiating with opt-out plaintiffs. The really important context there is that they received conditional leniency from the Department of Justice back in 2021.
Because they self-reported.
They self-reported and agreed to cooperate with the investigation.
And beyond just price fixing for the meat itself, there were also these major lawsuits about suppressing wages, correct?
Absolutely. The poultry wage rate litigation. It alleged collusion to keep wages down for their plant workers.
And they settled that one.
They reached an agreement to settle for $115.5 million this fiscal year. But while that specific case is resolved, there's similar litigation still ongoing in the beef and pork segments.
And just to round it all out, there was a $41 million product recall charge in prepared foods. So even their most profitable segment isn't immune.
Right. So you add it all up, the input costs, the goodwill impairment, the staggering legal accruals, and it becomes very clear why a company with growing sales saw its profit just evaporate.
Okay, moving on to strategy. Let's talk about scale and dependency. This is a $54 billion company, but who is their biggest customer?
That would be Walmart. Walmart accounted for 18.7% of their consolidated sales.
18.7%. That is a huge concentration. Nearly a fifth of your global sales tied to one single customer.
It's a massive exposure. They even state in the report that losing Walmart would have a material impact across all of their segments. That's a serious vulnerability.
Though they do have a huge global footprint otherwise.
Oh, absolutely. They sell in about 140 countries. Foreign sales were $7.4 billion this year. Markets like Canada, China, Japan, Mexico, they're all major buyers.
And with a workforce of 133,000 people globally, how are they handling things like retention in what's still a pretty tight labor market?
They're focused on it. They reported a 3.5% increase in their domestic retention rate this year. And they operate heavily with organized labor. About 31,000 of their U.S. workers are under collective bargaining agreements.
I found a really interesting detail in the sources about how they invest in their frontline workers, something called the Upward Academy.
Yes, that program is a fantastic example of strategic investment in human capital.
It's more than just job training, isn't it?
Much more. The Upward Academy offers classes on site, things like English as a second language, getting a high school diploma, digital literacy. And for career development, they'll provide up to $5,250 a year for college degrees or certifications.
At no cost to the employee.
At zero cost. That's a serious commitment.
All right, switching gears to a very modern threat, cybersecurity. How does a company this complex protect itself? Their reliance on IT must be total.
It is. They have a formal program led by a CISO built around the NIST framework. But what really signals how seriously they're taking this is a change they made this year.
What was that?
The board of directors appointed a special board technology committee. Its entire job is to oversee tech strategy and cyber protection. When it gets that level of board oversight, it's a top priority.
So final question on the financials. Despite the commodity crisis and the legal crisis, how stable are they? Can they actually weather all of this?
They seem to be. Their cash flow from operations was still a healthy $2.2 billion. And they have a strong liquidity buffer, a new $2.5 billion credit facility. Their net debt to EBITDA is manageable, around 3.0x. So they have the cash to pay the bills.
But those bills are definitely hurting the bottom line.
No question.
So what does this all mean for you? We've seen this company's core strength is clearly in its branded, value-added products like prepared foods. That's the profit engine. But that engine is being completely masked by these two massive headwinds.
Right. Extreme volatility in commodities on one side and these extraordinary, you could say, self-inflicted financial risks from historical legal issues on the other.
It's a fascinating tension, isn't it?
It really is. You have a highly optimized operation like the chicken segment running headfirst into this high-cost environment, and it's all compounded by these legacy legal problems. So instead of reinvesting all that capital into innovation or their people, they're forced to allocate hundreds of millions to litigation defense.
And that's the provocative thought we want to leave you with today. When you see a number like $738 million in legal accruals in a single year across beef, pork, and chicken, it just begs the question, how much of a company's focus, its capital, its operational bandwidth is perpetually tied up in just resolving the past?
And what does that constant drain on resources mean for the future of competition and innovation in the entire protein industry? Does fixing the past mean you have to delay the future?
That is the challenge they face. And that was our deep dive into the business of U.S. protein production.